Welcome back, accounting students. We are currently working on Chapter 12. We are on Lesson 2 in Chapter 12. Remember, Chapter 12 deals with preparing payroll records, and Lesson 2 in Chapter 12 is determining payroll tax withholding. So one of the things that you want to remember is that when you have employees working for you, the business is required to withhold taxes from the payroll for federal, for state, sometimes city and local taxes, and then that money that's withheld becomes a liability for the business until that money is submitted to the correct government agency. So determining payroll tax withholding is a fairly important part of processing payroll. So the three objectives in this lesson are demonstrate the process for determining federal income tax withholding, demonstrate the process for calculating Social Security and Medicare taxes, and explaining the benefit of funding medical and retirement plans with pre-tax contributions. So first thing you just want to be aware of, taxes that are based on the payroll of a business are called payroll taxes. That should feel like a no-brainer. And this is based on employee earnings. So whenever you pay employees either commission, salary, or wage, you need to calculate payroll taxes on those earnings. An employee fills out a form that we commonly refer to as a W-4. That is the withholding allowance certificate, and this is where employees elect to have how much money they would like to have withheld from their paychecks based on where they feel their taxable situation will be at the end of the year. So a deduction from total earnings for each person legally supported by a taxpayer is called a withholding allowance, and any amount withheld from an employee's gross earnings is called a payroll deduction. I'm sure some of you are working and you have filled out a W-4 form, and just to think through, if you have earnings of more than $950, then there has to be some withholding because you are not allowed to say that you're exempt. So there would be some payroll deduction happening for payroll taxes in that case. Now, here's a look at that W-4 form. I'm sure this looks very familiar to many of you. This is typically a full sheet, and on the back there's actually a worksheet that helps you determine how many exemptions you would claim, how many allowances you would claim. So you can see the information that is indicated and needs to be posted on the W-4, and the employee does need to sign it. Now, businesses rely on the federal government to generate some tax table information, and there are tax tables for each pay period type. So there are separate tax tables for weekly pay and bi-weekly pay and semi-monthly and monthly, so that the tax withholding is appropriate based on how much pay the employee is receiving over a certain amount of time. There are separate tables for single and married people, and what you do is you just look at, for a single person, how many withholding allowances they're claiming, and then you figure out what their income is for the time period represented, and you go ahead and say, all right, 2 allowances at this income, and this would be the amount of withholding for the time period. The married chart works the same way, so with 4 allowances and $1,460 in a semi-monthly or twice a month pay period would result in withholding of $29. Okay, so the next thing that's covered in this chapter is employee Social Security and Medicare tax. Now, the federal tax that is paid to folks that are old age, survivors, or disability is called Social Security tax. Then the federal tax that's paid for hospital insurance is the Medicare component. So what we see is that total gross earnings to date for an employee over the course of the year is their accumulated earnings, and the maximum amount of their earnings on which we can calculate a tax is called the tax base. Now, for Social Security, there's actually a limit on the earnings or the tax base. So when an employee earns a certain amount of money, every dollar after that amount is going to not have any Social Security tax withheld from it. Now, the book is using a tax-based limit of $106,800. In reality, for 2016, the Social Security tax base is 118,000. So the book is using a different number than is actually relevant. Now, Congress each year can adjust the Social Security tax base. So that number does occasionally change from year to year. I think the last time it changed, it moved up in 2015 from 2014, but in 2016 the number did not change. So just to kind of be aware that that Social Security tax base is not fixed. The Medicare tax applies to all dollars earned. So even after the limit on Social Security, you still go ahead and pay Medicare tax. Now, the Social Security tax rate is 6.2%, and the Medicare tax rate is 1.45%. So employers are required to deduct for Social Security taxes and for Medicare tax. All right, so in addition to the required withholding for Social Security and Medicare, employers also can opt to have some voluntary deductions from earnings, and this is pretty key for employees to be able to pay money on earnings pre-tax. So what this is saying here, first of all, just a couple of vocabulary items. A qualified retirement plan is a retirement savings plan that's approved by the IRS, and it allows participants to take advantage of some tax benefits. A 401k is a qualified retirement plan sponsored by an employer. A 403b is one that is sponsored by a nonprofit or a government entity. An individual retirement account is one that you as a single individual can take advantage of, different than a qualified plan that's offered through an employer. Finally, there's Roth individual retirement accounts, and this is a qualified retirement plan where you put your money in after you pay tax on it right now, and then the money grows tax-free, and when you take it out, it's tax-free as well. So an individual retirement plan, a qualified retirement plan, an IRA, a 401k or a 403b, that money goes in and you don't pay taxes on it when you put it in. It grows tax-free in the account, but you do pay taxes on that money when you take it out of the account. Now these are retirement accounts, so the intention is that you would leave the money in until you're at least 59 and a half, and in fact most of these plans you would be charged a 10% penalty that's payable to the federal government if you take the money out before you reach retirement age. All right, so before we do the audit your understanding piece, I would like to mention that in Chapter 12 on page 356 in your book, there is a really nice chart that walks through the benefit to employees and paying some of their benefits with pre-tax dollars. You can see that the savings are quite significant if you assume a tax rate of about 30%, that it reduces the amount of money that you have to pay in tax now and allows participants then to have more cash in the current and a lower tax liability in the current. So that's just a really nice example. In order for medical premiums to be paid pre-tax, the plan that's offered by the employer just has to be approved by the government, and it has to be a qualified plan. So that's just a couple of items to note. I would really encourage you to look at that little chart on page 356. It's just a nice representation, a good visual for you. Okay, so audit your understanding. Where does an employer get the information used to determine the amount of federal income tax so that they can withhold the correct amount from employees' earnings? That's going to come from the W-4, which is the Employees Withholding Allowance Certificate. Employee federal income tax withholdings are based on what two factors? Marital status and the number of withholding allowances. Does the employer or employee pay Social Security tax and Medicare tax? Both the employee and the employer pay. So the employee pays a portion and the employer pays a portion of these taxes. What is the difference in the impact of contributions between a 401k, an IRA, and a Roth IRA? The key part to remember here is that a Roth IRA is funded with after-tax dollars. A 401k and an IRA is funded with pre-tax dollars, so before payroll taxes are calculated. Are the withdrawals from a 401k, an IRA, and a Roth IRA subject to income taxes? Again, Roth IRA, because you put the money in after you paid taxes on it, you no longer have to pay tax on any of that money. So all of the money comes out tax-free. A 401k and an IRA, because the money went in before any payroll tax was deducted, you do pay payroll tax when the money comes out. All right, so that's the end of lesson 2 for chapter 12. Please go ahead and complete the forms. Oh, there's only one form for lesson 2. So go ahead and complete the form, work together and on your own, and then move on to lesson 3. Good luck.